I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. Why Bother with Bonds by Rick Van Ness is an excellent book for investors looking to understand the role of bonds in their portfolio. The book is written in a conversational tone and is easy to understand, making it accessible to both beginners and experienced investors. The book starts by explaining the basics of bonds, including the different types of bonds and how they work. It then goes on to discuss the advantages and disadvantages of investing in bonds, such as the lower risk compared to stocks, and the potential for higher returns than savings accounts. One of the key takeaways from the book is the importance of diversification in investment portfolios. The author emphasizes that bonds can play a crucial role in diversifying a portfolio and reducing overall risk. In addition to discussing the basics of bonds, the book also covers more advanced topics such as bond valuation, interest rate risk, and credit risk. The author provides practical advice on how to assess these risks and choose bonds that align with an investor's goals and risk tolerance. Overall, Why Bother with Bonds is a highly informative and practical guide to bond investing. The book is well written, easy to understand, and packed with useful information for both beginners and experienced investors. I highly recommend this book to anyone looking to understand the role of bonds in their investment portfolio. Point 1 from Why Bother with Bonds is that bonds are an important component of a diversified investment portfolio. The book explains that while stocks are often seen as the most exciting part of an investment portfolio, bonds can offer a lower-risk option that can still provide good returns. Bonds are essentially loans made to a borrower, with the bondholder, investor, receiving regular interest payments and the return of their principal investment at the end of the bond's term. Because bonds are generally considered less risky than stocks, they are often used as a way to diversify a portfolio and reduce overall risk. The author explains that while the returns from bonds may not be as high as those from stocks, they can still provide a reliable source of income and help to balance out the riskier parts of a portfolio. For example, if an investor has a portfolio heavily weighted towards stocks, adding bonds can help to reduce overall risk and create a more balanced portfolio. Furthermore, the author notes that bonds can offer potentially higher returns than savings accounts, while still providing a level of safety and stability that stocks may not be able to offer. Overall, the book argues that including bonds as part of a diversified investment portfolio can be a smart move for investors looking to balance risk and returns. Point 2 from Why Bother with Bonds is that there are different types of bonds, each with its own unique characteristics and risks. The book explains that understanding these different types of bonds is important when making investment decisions. Some of the main types of bonds include treasury bonds, municipal bonds, and corporate bonds. Treasury bonds are issued by the U.S. government and are generally considered to be the safest type of bond. They also tend to have lower interest rates compared to other types of bonds. Municipal bonds, on the other hand, are issued by state and local governments and are often used to finance infrastructure projects such as roads and schools. They can offer tax benefits to investors, but may also carry a higher risk of default compared to treasury bonds. Corporate bonds are issued by companies and can offer higher yields than treasury or municipal bonds, but also carry a higher risk of default. The book explains that investors should assess the creditworthiness of the company issuing the bond and look for bonds with a higher credit rating to reduce the risk of default. Overall, understanding the different types of bonds and their risks is important when choosing bonds for an investment portfolio. The book emphasizes that investors should choose bonds that align with their goals and risk tolerance, and diversify across different types of bonds to reduce overall risk. Point 3 from Why Bother with Bonds is that bond valuation is important to understand when choosing bonds, and factors such as interest rate risk and credit risk should be assessed when making investment decisions. The book explains that the value of a bond is determined by a number of factors, including its interest rate, its maturity date, and the creditworthiness of the issuer. Investors should understand how these factors interact and affect the value of a bond over time. Interest rate risk is one important factor to consider. If interest rates rise, the value of existing bonds will generally decrease, as newer bonds with higher interest rates become more attractive to investors. This can result in capital losses for bondholders if they need to sell the bond before maturity. Credit risk is another important factor to consider. This refers to the likelihood that the bond issuer will default on its debt obligations. Bonds with higher credit ratings generally have a lower risk of default, but also tend to offer lower yields. In contrast, bonds with lower credit ratings may offer higher yields, but also carry a higher risk of default. The book also explains that investors should assess the yield to maturity, YTM, of a bond, which takes into account both the interest payments and any capital gains or losses that may occur over the life of the bond. This can provide a more accurate picture of the expected return from the bond. Overall, understanding bond valuation and the risks associated with bonds is important when making investment decisions. The book emphasizes that investors should carefully consider their goals and risk tolerance when choosing bonds, and seek to diversify across different types of bonds to reduce overall risk. Point 4 from Why Bother with Bonds is that investors can use bond funds as a way to gain exposure to a diversified portfolio of bonds, while also benefiting from professional management and potentially lower costs. Bond funds are investment funds that pool money from multiple investors to buy a portfolio of bonds. These funds can offer a range of benefits, including diversification across different types of bonds and maturities, professional management, and potentially lower costs compared to buying individual bonds. The book explains that bond funds can be a good option for investors who want to gain exposure to a diversified portfolio of bonds, but may not have the expertise or resources to research and select individual bonds. Bond funds can also offer liquidity, as investors can buy and sell shares of the fund on the open market. Bond funds can be classified based on the type of bonds they invest in, such as government bonds, corporate bonds, or high-yield bonds. Investors should choose a bond fund that aligns with their investment goals and risk tolerance. One potential downside of bond funds is that they may be subject to fluctuations in interest rates and market conditions, which can affect the value of the fund's shares. However, the book notes that this risk can be mitigated by choosing a fund with a diversified portfolio of bonds and a focus on risk management. Overall, bond funds can be a convenient and cost-effective way for investors to gain exposure to a diversified portfolio of bonds, while also benefiting from professional management and potentially lower costs. Investors should choose a bond fund that aligns with their investment goals and risk tolerance, and be aware of the risks associated with these funds. Point 5 from Why Bother with Bonds is that investors should consider the tax implications of their bond investments, as the tax treatment of bonds can vary depending on the type of bond and the investor's tax situation. The book explains that interest income from bonds is generally subject to federal and state income taxes. However, certain types of bonds, such as municipal bonds, may be exempt from federal and/or state income taxes. This can make municipal bonds an attractive option for investors in higher tax brackets. The book also notes that capital gains and losses from bonds can have different tax implications compared to stocks. If an investor sells a bond for more than they paid for it, they will realize a capital gain, which may be subject to capital gains taxes. In contrast, if an investor sells a bond for less than they paid for it, they will realize a capital loss, which can be used to offset other capital gains and potentially reduce their tax liability. The book emphasizes that investors should carefully consider their tax situation and the tax implications of their bond investments when making investment decisions. Investors may want to consult with a tax professional or financial advisor to determine the most tax-efficient investment strategy. In addition, the book notes that investors should consider the impact of taxes on their overall investment returns. Even a small difference in tax efficiency can add up over time, and affect an investor's long-term returns. Overall, understanding the tax implications of bond investments is an important consideration for investors. By choosing tax-efficient bond investments and strategies, investors can potentially reduce their tax liability and increase their overall investment returns. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.